On Friday, March 10th, 2023, banking regulators shut down the Silicon Valley Bank, a once thriving financial institution that specialized in serving tech companies. The SVB recently started facing insurmountable losses and had to declare bankruptcy. The downfall of the Silicon Valley Bank didn't just affect the bank's shareholders and customers, it also had a significant impact on the broader stock market. In fact, according to a study conducted by the University of California, the collapse of the SVB caused the stock market to lose over $50 billion in value in just a single day. To put that into perspective, that's the equivalent to the GDP of Bolivia. But how did this happen? And what were the long-term effects of the Silicon Valley Bank collapse on the stock market and the tech industry as a whole? Join us as we explore the shocking story of how the SVB Bank collapse sent shockwaves through the financial world and what savvy investors like you can learn from this downfall. Before we dive in, hit that subscribe button. Now, let's talk a bit about the origin of the Silicon Valley Bank. The SVB, the Silicon Valley Bank, is a commercial bank with its headquarters in Santa Clara, California, that specializes in offering financial services to technology and innovation companies, as well as venture capital firms and private equity firms. SVB also serves as a financial partner to private equity and venture capital firms. The megabank was founded by William Biggerstaff in 1983, and Apple Computer was its first customer. Fun fact. Since that time, the bank has grown to become a significant participant in the technology sector all on its own. It now has locations in several different continents, including the United States, Europe, and Asia. Commercial banking, investment banking, and asset management are among the services offered by SVB. The company has a specialized emphasis on venture debt, venture capital, and private equity investment opportunities. It provides a wide variety of financial goods and services, including investment management, cash management, foreign exchange, and credit lines and loans. The success of the bank may be attributed, at least in part, to a tight connection that it has with the technological sector, especially with Silicon Valley, where the bank has been instrumental in the funding and the support of startups and other rising enterprises. In addition, throughout the years, it's extended its sphere of influence to include other centers of invention across the globe, such as New York City, Boston, London, and China. Let's now look at the unique position that SVB held in the stock market. Since its establishment in 1983, the Silicon Valley Bank has been the financial institution of choice for new businesses and companies that invest in venture capital. Customers having accounts up to $250,000, which is the maximum limit of the FDIC's basic deposit protection, will be able to access their money as of Monday, as the regulators have now moved those savings that were kept at the bank to a newly established lender. Individuals who have deposits of more than $250,000 have been asked to contact a certain number. According to The Verge, a recent filing revealed that more than 90% of deposits at SVB were not covered by deposit insurance. According to the Boston Globe, customers who deposited more than the $250,000 were handed a receivership certificate. These customers will not have fast access to their assets unless the bank is promptly acquired by a viable competitor. As a result of the failure of the Silicon Valley Bank, many fledgling technology companies and their investors are rushing to determine their level of financial risk, as well as whether or not they'll be able to continue business as usual and pay their employees. The collapse of the Silicon Valley Bank has jolted the markets, causing stock prices to fall sharply. Now, the bankruptcy of the SVB in California on Friday prompted global worry about the health of our banking sector. This, in turn, heightened the investors' fears about the health of the economy as a whole, which resulted in a decline in the stock markets throughout the globe. The Federal Deposit Insurance Corporation acquired control of Silicon Valley Bank in the wee hours of Friday morning. The firm decided to close the bank as a direct consequence of the wild trading that occurred on Thursday and continued into Friday. SVB said that it needed to take immediate action to shore up its finances, and the company decided as a direct result of the turbulent trading it needed to do so, and quick. The Standard & Poor's Index had a loss of 1.4 percentage points on Friday, increasing its weekly loss to 4.5 percentage points and making it the index's worst week of the year. After dropping each day of the week, the KBW Bank Index, which measures the stocks of 24 major banks and was also lower, completed the week with a loss of more than 15%. This loss was because the index continued to decline. On Friday, Treasury Secretary testified in front of the House Ways and Means Committee. She said that she's keeping a close watch on the present situation and that she was monitoring it. The chairman of the Federal Reserve, Jerome Powell, testified in front of legislatures on Tuesday that the Federal Reserve may need to increase interest rates more than it expected, and perhaps at a quicker pace to bring inflation under control. In an attempt to bring down the rate of inflation, he made this comment. The rise in interest rates has a negative influence on stock prices and raises the possibility the activities of the Fed will lead the economy to enter a recession. Both of these effects are caused by the Fed's decision to raise interest rates. The employment report for Friday, which was announced on Friday, managed to calm some of these anxieties to some degree. This is what was released in the report. The report indicated a slower rise in wages and an increase in unemployment, which are two data points that signal the Federal Reserve's attempt to slow the economy and rein in inflation may be effective. The Federal Reserve is attempting to slow the economy and bring inflation under control. Several experts project that the Federal Reserve will feel less pressure to increase interest rates at its meeting later this month as a consequence of the employment data that was announced on Friday. As a direct consequence of this development, wagers placed on the financial markets have reoriented themselves towards anticipating a more modest rate hike of just a quarter point rather than a rise of a half of a point. Below the surface of the statistics, market analyst Ron Temple of Lazard said that there were indicators that wages continue to grow for portions of the labor force and that robust hiring remained a problem for concern. Given the divergent views of investors, it seems probable that the data on consumer price inflation that will be made public the week after that will be the deciding factor, all in determining what the Federal Reserve will do when it meets. The yield on the 2-year U.S. government bond, which is susceptible to variations and changes in expectations of future interest rates, jumped above 5% on Tuesday for the first time since the middle of 2007. This was the first time this has happened since 2007 and the 2008 crash. On the other hand, the trend was reserved as a result of the failure of the SVB, which raised concerns about the implications about the higher interest rates and what it would have on the economy, and the encouraging news regarding the job market, which reduced the need for additional hikes. Both of these events combined to reduce the need for additional rate hikes. By the end of the previous week, the yield had hit a 4.58%. According to Lauren Goodwin, an economist at New York Life Investments, the banking industry is a good indicator of what investors think will happen to other sectors of the economy if interest rates continue to go higher. This is because the banking industry is a good indicator of what investors believe will happen in other sectors of the economy. Joe Renison is a journalist who writes on international commerce and financial markets. His beat involves a broad range of themes, such as reporting on the illogical behavior of the stock market and understanding the trading decisions made by Wall Street insiders, which may at times be unintelligible. He also deciphers the trading choices made by hedge fund managers. The SVB, which was the 16th largest bank in the United States, was closed down by regulators on Friday as a result of the bank run that was caused by attempts to recuperate deposit losses via the selling of government bonds and securities. It was badly harmed by the plan of the Federal Reserve to increase interest rates, as well as the shortage of funding in the information technology and startup sectors. All of these factors combined to have a negative effect. You see, the majority of customers were new companies with strong emphasis on technology that had started to see an increase in their financial requirements over the previous year. On Monday, the Federal Deposit Insurance Corporation, FDIC, is expected to reopen with FDIC in charge. The failure of Silicon Valley Bank is the most significant financial crisis to hit the United States since the collapse of Washington Mutual in 2008. However, given that Silicon Valley Bank is a boutique bank with a specific portfolio that caters to the needs of the U.S. technological enterprises and capital venture, further pockets of instability are likely to emerge soon. The FDIC is likely to find a solution. Therefore, depositors should remain positive about the situation. Authorities in the United States and other countries have established more stringent restrictions to ensure that the failure of a single bank will not trigger a chain reaction that could damage the economic system as a whole. Janet Yellen, the Secretary of the United States Treasury, has stated her confidence in the nation's banking sector, which is more diversified across several enterprises, clients, and geographical locations. The collapse of Silicon Valley Bank, an institution that held the financial reserves of 26% of high-tech companies, including Roku, a producer of streaming gadgets, has created an atmosphere of dread. On the other hand, Saturday was spent in a condition of growing dread by smaller enterprises since companies relying on SVB started to worry about their ability to continue paying their personnel after the shutdown. Now, What projections do we have in place to cushion the Silicon Valley Bank and its customers? If continuous due diligence from each firm is required, there will be a significant improvement in levels of stability. As a result, businesses should not fail because the bank they hired was unsuccessful. Yet the state of fear persisted throughout the day on Saturday, and some firms sent emails to other businesses begging them to move their money from smaller, more specialized banks to one of the major four banks. While it's thought that just a tiny fraction of the SVB Group's overall business, namely 3% of its total clientele, originates from outside of Europe, the SVB Group has offices located across Europe. The authorities in charge of regulation in Germany and the United Kingdom are keeping a close check on the effects of the SVB's downfall, but the outlook for its future in other countries is generally optimistic. According to Domalewski, some of these strategic precautions have been in place since the 2008 recession. As an investor, what should you do in case of a collapse in your investment? Investment failures can be emotionally devastating, leaving investors with feelings of disappointment and regret. However, there are some steps you can take to mitigate the impact of the situation and potentially turn things around. Understanding the root cause of the failure is crucial. Was it a market downturn, poor leadership, or regulatory issues? Pinpointing the problem can help you make more informed decisions in the future. In the case of a technology firm experiencing a data breach, you need to investigate the situation before deciding to sell or hold on to your shares. If you believe the company has a solid plan to address the issue and prevent further breaches, it may be wise to stay invested. However, on the other hand, if the response is inadequate or the breach poses long-term risk, cutting your losses may be your best course of action. Remember to remain calm and avoid making impulsive decisions when investments decline. Panic selling can lead to greater financial losses when taking a more objective approach can provide a clearer picture of the situation. For example, researching market trends can help you determine whether a decline in a cryptocurrency's value is a temporary setback or a sign of a more significant problem. Finally, diversifying your portfolio can help you protect from the impact of single investment failure. Holding assets across multiple categories, firms, or sectors can reduce the risk of losing everything if one company or industry suffers a significant decline. A well-diversified portfolio can provide a buffer against losses and help you weather market volatility with greater resilience. Now, what lessons can we learn from the collapse of SVB? The failure of the Silicon Valley Bank may be traced back to several causes, the most prominent of which include excessive dependence on a select group of important customers, losing lending criteria, and extremely ambitious growth. The failure of SVB can teach some of us valuable lessons, one of which is the need for diversification. You see, the SVB had a loan portfolio that was highly concentrated, with a considerable amount of its total loans going to a small number of customers. SVB took a significant blow as a result of the financial troubles encountered by some of those customers, and its position in the market soon worsened as a result. Investors who had placed all of their money in SVB or one of its related funds were forced to take huge losses as a direct consequence of that decision in the company's actions. From the downfall of SVB, we can gather the benefit of conducting thorough due diligence. Many investors place their faith in SVB because of its standing as a preeminent technology leader and the bank's reputation for sound judgment and industry knowledge. On the other hand, it came out that SVB's credit criteria were not as tight as they should have been, and the bank had taken a large amount of risk all in its loan portfolio. When the bank failed, investors who had not conducted their research on the firm's lending policies and risk management procedures were taken aback by the outcome. Now, following the collapse of SVB, investors who had not conducted their research on the firm's lending policies and risk procedures were taken aback by the outcome. One good illustration of this is the situation involving the investment company Marwin Investment Management, which is situated in the UK. Marwin had invested in one of SVB's associated funds without having a complete grasp of the dangers involved. Marwin lost its entire investment as a result of the failure of the bank. Another takeaway message that we can learn from the collapse of SVB is the dangers that come with rapid growth. ComVentures, a pioneering venture capital company with the concentration on technology, serves as a good illustration of this principle. ComVentures' financial situation was badly harmed as a result of the failure of SVB's affiliated funds, in which the company had extensively invested before the failure of the bank. Several industry commentators believe that ComVentures' internal controls and risk management procedures had not kept up with the company's fast expansion into new product lines and markets. ComVentures had likewise grown swiftly into new product lines and ventures all on their own. Now, the fall of the Silicon Valley Bank serves as a powerful reminder of the benefits of diversification, doing thorough due diligence and prudent risk management all at the same time. By heeding these lessons, you can better prepare yourself for any future challenges that may arise in the stock market. So, as you continue your investment journey, remember to keep those lessons in mind and always do your research and consultation before making any investment decisions. If you found this video valuable, smash that like button and subscribe to our channel. Thanks for watching, and I'll see you in the next one. Cheers.